Here's something that will keep you up at night. Right now, someone is opening a brokerage account, buying their first stock, feeling smart and responsible, and making one of the most expensive financial mistakes of their life. Not because investing is wrong, because of what's sitting on the other side of their financial life. A credit card charging 22% interest, an empty savings account, 3 years of unclaimed employer 401k match. I obsess over the math behind money, specifically the order in which you move it. Because nobody tells you this when you're excited to start building wealth. The sequence matters just as much as the strategy. Get the order wrong, and you can spend a decade investing consistently and still end up behind where you started. This is the exact roadmap. Stay with me. Picture yourself filling a bucket with water. Steady stream, working hard, water rising. But there are holes punched along the sides, and the water drains out faster than you pour it in. That's what it looks like to invest while carrying high-interest debt and zero financial safety net. Every dollar you add at the top leaks out somewhere below. You feel productive. The math silently destroys you. The solution isn't to pour faster. Fix the holes first. Step 1. Build your emergency buffer. Before a single dollar goes anywhere else, you need a financial floor. 1 in 3 Americans has no emergency fund at all. The median emergency savings right now is around $500, less than most people's monthly car payment, down from $600 just a year ago. These are the same people asking which cryptocurrency to buy. An emergency fund isn't a boring suggestion. It's the only thing standing between your investment strategy and total collapse when life does what life always does: break something expensive at the worst possible moment. Start with $1,000, park it in a high-yield savings account. Don't touch it. Research from Vanguard found that people with just $2,000 in emergency savings scored 21% higher on financial well-being than those with nothing, the largest boost tied to any single financial factor they measured. From there, build toward 3 months of expenses. 6 if you're self-employed or in a volatile field. Not exciting. But without it, every other step is built on sand. Step 2. Kill the high-interest debt. Now we fix the holes. Any debt above 8% annually needs to go before you think seriously about investing. Credit card debt, currently averaging above 22% is financial cancer. It grows faster than almost any reasonable market return you can expect. Here's the number that should stop you cold. A $5,000 credit card balance at 22%, minimum payments only, costs you nearly $2,800 in interest over 5 years. That money never compounds. It never grows. It simply vanishes and takes more with it every month. Paying that debt off is a guaranteed 22% return. Warren Buffett has averaged around 20% annually over his entire career. You have a better opportunity sitting in your wallet right now than the greatest investor alive. And most people ignore it to chase stocks. Use the debt avalanche. List every debt by interest rate, highest to lowest. Pay minimums on everything. Throw every extra dollar at the top of the list. When it's gone, roll that payment into the next one. Not viral, not flashy, just mathematically optimal. Step 3. Capture every dollar of employer match. Here's where logic breaks down for most people. You'd think, clear all debt, then invest. And mostly that's right, except for one scenario that completely changes the math. If your employer matches retirement contributions, grab that match before almost anything else. Even before you finish clearing debt, think about what a match actually is. No investment anywhere can promise that. It's free money with an expiration date, and most people let it expire. Contribute exactly enough to capture the full match, not a dollar more. Direct everything else toward debt. Once the debt is gone, come back and increase contributions. Just know your vesting schedule first. Some employers require you to stay a certain number of years before that matched money is truly yours. Step 4. Max out your IRA debt gone. Match captured. Now maximize your individual retirement account before adding more to your 401k. This surprises people. They assume more 401k is always better. But your IRA gives you something most employer plans don't: freedom. Corporate 401k plans typically offer a narrow fund menu with fees between 1 and 2% annually. That sounds small. Compound that fee drag over 30 years, and you've handed tens of thousands of dollars to fund managers who are not losing sleep over your retirement timeline. An IRA lets you choose your own low-cost index funds charging a fraction of a percent that track the entire market. For 2025, the limit is $7,000 or $8,000 if you're 50 or older. On traditional versus Roth, lower tax bracket now, expect to earn more later. Go Roth. Peak earning years now, expecting lower income in retirement. Go traditional. Genuinely unsure. Split both and build tax flexibility either way. Step 5. The most underused account in America. If you have access to a health savings account and aren't using it aggressively, you're leaving the most powerful tax vehicle in existence completely untouched. An HSA gives you 3 tax advantages no other account offers. You contribute pre-tax. It grows tax-free. Withdrawals for medical expenses are completely tax-free, even decades later. The strategy that makes this extraordinary: pay current medical bills out of pocket when possible, keep every receipt, let the HSA stay fully invested. There's no expiration on HSA reimbursements. Pay for a doctor visit today, save the paperwork, and legally withdraw that same amount tax-free from your HSA 15 years from now. For 2025, $4,300 with individual coverage, $8,555 with a family plan. Max this annually for 30 years at 7% returns, and you're looking at over $400,000 in tax-free dollars for healthcare. The average retiring couple will spend more than $300,000 on medical costs. The HSA can make that entire bill disappear. Step 6. Max the 401k. Now go back and push your employer plan to the limit. $23,500 for 2025 or $31,000 if you're 50 or older. Between your IRA, HSA, and 401k, you could shelter more than $35,000 annually from taxation. That's serious compounding power the government never gets to touch. The average American saves around 6% of their income, usually not enough to even capture the full employer match. If you followed this sequence, you're already operating in a completely different category. Step 7. Now, taxable accounts. This is the step everyone wants to start with. It's last for a reason. Taxable brokerage accounts are powerful. No contribution limits, no withdrawal restrictions, complete flexibility. But they carry tax drag that quietly erodes returns every single year. Dividends taxed annually. Capital gains every time you sell. It's investing with sand in your shoes. Once your tax-advantaged options are fully maxed, taxable accounts become the right move, especially for goals outside retirement, early financial independence, or generational wealth building. The sequence is everything: emergency fund, high-interest debt, employer match, IRA, HSA, max the 401k, then taxable accounts. Follow this order and you're not just investing, you're engineering an outcome most people will only watch from the outside, wondering how you got there. If this hit differently than what you expected, drop your biggest takeaway in the comments. I read every one. Share this with someone who's about to make an expensive mistake with their money. Hit like if it was worth your time. And if you're serious about building real wealth, not just thinking about it, subscribe now because the next video will change how you see money entirely.